Okay, good afternoon, everybody. It is 12 o'clock, and we're here at the PUB's main office. It's May 28th. I'd like to call the meeting to order. We do have a quorum. Any public comments?
No public comments.
No public comments, so we'll go ahead and move forward with the agenda. The first item, presentation, discussion of the Brownsville Public Utilities Board's financial performance report for the period ending April 30th, 2025.
Yeah. Good afternoon, Mr. Chair, member of the committee. So my name is Mike Bettis. I'm the Chief Financial Officer, and I'll be presenting the financial performance report as of April 30, 2025. So here we've got the executive summary made up of 7 categories, and each of the categories is on gauge meter, with red representing poor, yellow average, and green is good. On the flow of funds, we did generate $2.6 million to replenish the improvement fund with a debt service coverage ratio of rate of 2.23 times, well above the 1.25 times minimum requirement. The FPEC, or fuel purchase and energy charge, has generated an over recovery of $21.19 million as of April 30, and this will be used to offset future market uncertainty. Current rate is at 0.05019, and it's been at that for the past 9 months, since September of 24. The COB cash transfer is a little bit lower than budget due to a decrease in adjusted gross revenues, but they still, so cash the cash transfer is $100,000 under the budget, but it is $500,000 above prior year's level. Personal and non-personal expenses came in lower than budgeted at $4.7 million under budget, primarily due to some current vacancies and timing issues. BPUB's average bill is lower than both the average MOU bill and the average IOU bill for the 1,000 kWh user. Our current bill is at about $111.26. On the CIP, year-to-date actuals and committed total to $26.3 million and $42.6 million respectively, which represent about 91% of the fiscal year 25 approved plan. And all key financial metrics are currently in compliance. So in light of the lengthy board items that we have, I'm just going to focus on the year-to-date column for now, and we'll be reporting this financials at the board meeting on Monday. So starting off, we've got the statement of revenues, expense, and changes to net position. This is in compliance with generally accepted accounting principles. We got operating revenues at $127,208,000. We back out operating expenses of $110,574,000 and end up with operating income of $16,634,000. Once we back out the non-operating expenses of $10,835,000, we arrive at income before capital contributions of $5,798,000. We add in the capital contributions year-to-date of $9,132,000, and we end up with an increase in net position year-to-date of $14,930,000. So adding this to the net position at the beginning of the fiscal year, we end up with the net position at the end of the period of $490,067,000. Here we've got the summary of revenues and expenses. This is based on the flow of funds, so this is in compliance with the bond ordinance. Year-to-date numbers, operating revenues, $121,368,000. Other revenues came in at $14,238,000. So total gross revenues were $135,606,000. Once we back out the fuel and the South Most Regional Water Authority contributions of $42,865,000, we arrive at adjusted gross revenues of $92,741,000. This is the amount that we use to calculate the City of Brownsville 10% cash transfer calculation. So they are entitled to 10%, or $9,274,000. Line 6, we back out other requirements for the O&M, non-operating and debt service, of $72,185,000, and we end up with a balance available after requirements of $20,555,000. Now we do back out the total cash and utility benefit to the City of Brownsville of $9,274,000, and we end up with a balance available for transfers out of $11,281,000. These funds were then used to fund $8,650,000 in transfers out. This is for our CIP and any reserve requirements that we have, leaving a balance of $2,631,000 to replenish the improvement fund. That concludes the financial presentation. I'd be glad to answer any questions.
No questions.
Thank you.
Thank you. Okay, we have our second item here. Presentation and discussion on the RFP for the commercial paper irrevocable letter of credit provider and debt overview.
Yes, good afternoon again, Mr. Chair and members of the committee. So BPUB is on its third and final year of a 3-year agreement with PNC Bank as the letter of credit provider for BPUB's commercial paper program. The agreement is due to expire on November 7th, 2025. As a result, we issued and advertised an RFP for a new letter of credit provider this past Saturday. Second advertisement will be held this Saturday. So with us today, we have Noe Hinojosa with Estrada Hinojosa to provide an overview of BPUB's commercial paper program, provide a review a timeline for the RFP process, and provide a debt overview and potential revenue bond refunding opportunity. Noe?
Thank you, Mike. Mr. Chairman, it's good to see you both. It's been a while since I've been to a PUB board meeting, so I'm a little rough. So if I don't do well,
Thank you for bringing the rain, Noe.
well, it affects our revenues, you know. So, but rain is always good. In any event, if you recall, the debt portfolio of PUB is a combination of fixed rate debt, long-term debt, and commercial paper. And commercial paper is basically a tool that we have used for now a good 10, 11 years. And we normally use that in case of unexpected expenses that come through the year or for special projects. And the way it works, very similar to a commercial bank, is basically like a credit card. And we go out and tap into it. And in order to have access to this kind of a program, you got to have a liquidity provider or letter of credit provider. In this case, it's PNC. And that relationship basically ends at the time that the program basically matures. And as Mike pointed out, the program pretty much is going to end up here on November 7th of 25. And so what we're trying to do is beat that clock. So we're getting this program started. The process is such that we come to you before the board meeting. Then if the board so agrees with you, if in fact you agree with this recommendation, then we take it to the commission. So there are a few steps to get there, and we think we will get there sometime in September. So what we're trying to do, the $100 million program right now has outstanding about $30 million. So normally, when you have that kind of a balance and you're renewing the paper, you clean the balance out, you go out and do what we call a fix out. So we fix out the $30 million loan and add it to what's currently outstanding. So in the documents that you have received shows where we are in terms of debt. You go to page 12 real quick. See. You go to page 9, I'm sorry. On page 9, it pretty much gives you a list of all the bonds that are currently outstanding. So we got fixed rate loans dated 2005 all the way out to 2022. And the sum of what is outstanding is $254,450,000. When you add $30 million, we're at $284,450,000. And basically what's in there in that little rectangle is something we want to discuss a little further. But what we're doing here is get the authority from you to extend that commercial paper if in fact you believe it's important to have. We think it's important to have it. It's worked out very well for the PUB in the past. I will tell you that back when we instituted this program, the fund balances were not as strong as they are today. Today, you have very sound financial numbers in terms of cash on hand and so on and so forth. I think we have over 400 days, you said? 435, and but you know, we get a disaster come our way, and that's not, you don't have enough money, and this is pretty cheap money. To give you an idea, PNC charges you 32 basis points for being the provider of the service. So 32 basis points on 100 million is $320,000. So what we do normally is, in this case, we're going out. We have recommended staff to go out and solicit the services of the letter of credit provider, and I think we have a list of at least 8 or 10 of them, right? And including Frost and Truist, and then the big boys on Wall Street. and hopefully they'll come back to us before the program expires, and we'll be able to analyze those responses and make a recommendation to you as to who the LOC provider will be. Coupled with that, you have a marketing agent. So the marketing agent is basically someone that your staff calls whenever we need that cash. And thus, if we have $30 million, when we pull out that money, they normally price those $30 million, and you don't do it $30 million in a chunk, you do it $5 million at a time. That's how you get to the $30 million. But basically, JP Morgan serves as a remarketing agent. So we'll call JP Morgan and say, JP, send us a $5 million loan. Can you give me a price for that? And they'll normally go to the SIFMA index, which is one of the indexes monitored out of New York, and is a 270-day short-term paper. And we pay JP Morgan 4 basis points for that service anytime we use them, or I think it's more a quarterly fee that we pay them. But that's not our for service. I'm just trying to give you an idea how the program works. So so basically, our position is to see if you agree with us in that the CP should be kept in place, and then we will fix out the paper, going out long-term debt with these bonds. And when you go to page, basically page 12, you'll see that along with the fix-out, interest rates, despite the fact that they're high, we got some bonds that have are being mature in 2025, and you don't have to pay penalties on it. So we think at today's rates, there are three columns on the bottom left, and you'll see those where the first column basically shows a refinancing of current debt at a rate, they have rates of about 4.812, and we will refinance those with a 3.35.4. Now, that's today. If you proceed in going forward with this financing, and the board basically agrees with us on Monday, we'll probably go to the commission a couple of weeks later. So we're talking about financing maybe sometime early July, mid-July, to get this cleaned up before when the program expires. So we're looking at sometime closing sometime in August, I think. But having said all that, the first column is current market rates. If the market improves, you could get a little bit more juice. The savings are $1,390,000 on a present value savings, or $1,777,000 if it improves by 0.25%. And if it's 50, you get even $2,188,000. I will tell you that I've been in this business long enough to see that since April the 2nd, when tariffs were announced, I've never seen so much volatility. I'm sure you're in the banking business, Al, so you've probably seen it too, that it's just a crazy time to see how much rates have moved against us and in favor from one day to the next. But it's been very volatile, and all we can do for now is just plan. If the refundings are not there, if the market goes away from us, we'll just do the $30 million takeout, and that's what this is about. So I'll stop and entertain questions you may have.
Yeah. Hey, Noe, can you go back to slide number 9?
Yes, sir.
I just wanted to, you addressed it, but I'm not sure I understood correctly.
Yes.
So the bond that's highlighted in yellow, that's callable. It's on September 1st, right?
That's right.
In orange, did I say yellow?
Yeah.
Where did
Some
that come
UT
from?
color. I
That's
didn't
which I don't
do
understand.
that.
But I mean, the probability of that being called is what would you, 100%? Or
Well, no, not at all. I mean, if you remember, you're the one that has the option to call in the bonds. So
Okay.
if I own those bonds and you pay me a 481 or 5% coupon, I want to continue to enjoy that interest
Okay,
rate.
so that callable option is, if we don't do anything, it just continues to go to final maturity?
Exactly. So literally, if you call them in, you call them in with new bonds being issued, right? You're going to borrow it at, let's say, 3.5%. You're going to take out 481. So if you decide not to do that, then you're just basically passing the benefit to the investor.
Right.
So it's not an uncommon practice
Okay.
for the borrower to say, hey, give me the savings. versus the investor having a little bit more yield.
And then can you please go back to, I think it was slide 12?
Yes, sir.
The last one that you were on?
Mm-hmm.
So the callable amount was $41 million.
That's right.
Okay, so based on that $40 million, you're saying the current market rates right now?
Yes, we would only excellent question. So basically, if you go to the third row of the first column on the bottom left, you'll see how we're only calling in 28,360,000. So out of the candidates, 41,680,000, we're only able to call 28,360,000, because that's what most of the juice is.
Okay.
If I get 31 million or 35 million, you're gonna get less savings. You make the issue bigger, the underwriters, even me, will be happier, but we wanna be the most efficient in the transaction. So if it improves, for example, if it improves 50 basis points, or 50 basis points, instead of refunding 28,360,000, we'll take out 36,415,000.
Okay. Okay.
Ideally is to have a perfect refunding, but, rates probably have to go up 75 basis points, which is not likely in today's market. But, we'll monitor. I mean, the way we do it is we go out thinking it's a $40 million transaction, but then if it's not there, the one that really, the number you got to look at is where he says average, where it says percent of savings of refunded bonds, right below that number of 1,390,000, that shows 4.9%. So basically, in fact, Mike and I were talking about this earlier, we normally have a barometer in our business that if anything that is over 4%, if you've refinanced $100 million, to give you an example, if you could get $4 million in savings, that's when, in our industry, we say that's something worth doing.
Okay.
Okay? So here, we're at 490. If the rates improve, we could get 513. If it even gets better, it's 6%. So it's a function of how the markets are gonna be doing in the next month and a half or so.
Okay.
Sorry but great, good questions, yeah.
Actually, that took care of my questions.
I think that's it.
Thank you.
Thank you for the
gentlemen.
presentation.
Good to see
Appreciate
you. Yes, sir.
it. Okay. So that will be presented to the board, right, Mike, on Monday?
Yes, we expect the proposals to come in on June the 18th, so we'll be back to the Finance Committee first on July 2nd
Okay.
to provide our recommendation, and then the board on July the 7th, Monday
Okay.
the 7th.
Item number 3, presentation, discussion, and possible recommendation on grant management and consulting services agreement renewal.
Good afternoon, Mr. Chair and committee members. My name is Jorge Santillan, Finance Manager. Let me go over a background on this item. On March 11, 2024, the BPUB board selected iParametrics LLC to provide grant management and consulting services. A one-year agreement between BPUB and iParametrics commenced on May 28, 2024, with provisions for up to 3 one-year renewals. The initial year cost was estimated at $70,350, with iParametrics expected to assist grant staff in submitting 3 grant applications. During the first year of the agreement, iParametric assisted grants staff in submitting 4 grant applications totaling $15 million. These applications are still in the review process by respective grant agencies. Other services provided by iParametrics included the assisting with grant compliance, need assessments, participating in need assessments with meetings with various divisions, and conducting regular meetings with grant staff to discuss possible grant opportunities. These are potential grant funding opportunities where we are currently exploring, where we might use iParametrics technical assistance and depending on the application requirements. Our staff recommendation is we recommend a one-year contract renewal with iParametrics LLC, estimated at $70,000. The actual cost will be based on hours of work for services provided and as needed. Let me also add that we plan to present this agenda to the upcoming full board meeting on June the 2nd, and we would like to request your authorization to proceed, and if okay, to include it in the consent or a separate agenda item.
I should warn you all, there are going to be questions about exactly how these people help us out. Not saying that I'm against it, I think it's a great idea. But I know at least one board member also does a lot of grants, and she'll be asking a lot of questions about it, so.
Yeah, so I was going to recommend that we put it as a consent agenda item, but based on that, I just probably put it as a non-consent agenda item then, okay?
Okay.
Very good, thank you.
Thank you.
I'm sorry.
But we'll see that.
Okay, number 4, presentation and discussion on the operations and maintenance 6-month budget review.
Yes, committee members, a brief overview of the budget review process. On March 31st marks the halfway point of the fiscal year. This triggers the 6-month budget review that Finance coordinates to ensure that the approved O&M budget is accurate and on track. Once all expenditures have been recorded and the month is closed, Finance staff runs budget and actual reports for all departments. Budgets are reviewed by Finance staff, and specific accounts are identified for review based on percentage spent and previous year spending trends, and then forwarded to the departments for their comments. During this process, Finance and the departments have discussions to ensure that their spending levels are on track, and if adjustments need to be made, this is the time to do so. Transfer may be needed to replenish accounts that may be over budget. However, sometimes the departments will identify budget amounts that will no longer be needed. Once identified, these funds are transferred to the contingency pool so Finance can reallocate if necessary throughout the remainder of the year. Now, this is an overview of the FY 2025 mid-year O&M budget summary. Looking at the left side, the total O&M budget for FY 25 is $203 million. The year-to-date actuals shown in light blue, in the lighter blue color, it's $83.2 million, or 41% of the budget. That leaves a budget balance of $119.8 million, or 59% of the budget. At the bottom, we show the outstanding purchase orders, $19.1 million. These will become expenses later in the year, and some of those will be rolled over into next fiscal year. Moving on to the right side, we have the budget by account type, and these are the classifications that we use for budget purposes. And this is from largest to smallest. And the dark blue, we have the budget, and in lighter blue, the amount spent, and then we have the percentage of budget spent. The first one, the fuel and purchase power, the percentage of budget spent is 34.7%, and now this is anticipated, that most of the expenses happen the second half of the year, so this amount is anticipated. Then we have the personal services, 47.6%, and this is where we want to be. We want to be at 50% or less than 50%. Now, I would like to point out that these two account types, they make up 75% of the total O&M budget. Then we have consultant outside services. This includes engineering, legal fees, and software maintenance. 40.6% of the budget has been spent. We have then the miscellaneous general expenses, which this includes obligations to the SRWA, insurance. 48.4% of the budget has been spent. Then we have materials and supplies, 45.8% spent. Office expenses, this includes utilities, training and travel expenses, dues, and office supplies. 52.3% of the budget has been spent. Maintenance, this includes maintenance of equipment, building, and structures. 32.6% of the budget has been spent. Then minor tools and equipment includes computer equipment and software licenses, 44.2%. And then we have transportation, and this includes the fuel and fleet maintenance and repairs, 67.5%. Now, on this we're higher than the desired percentage. So on this one, we're monitor these expenses, and we'll transfer additional funds as needed later in the year. And we have other additional worksheets for your review, and in this one we have the non-personnel O&M spending by division. And this excludes personnel, fuel, and purchase energy, and SRWA contributions. Again, looking at the bottom percentage, 43.8% of the budget has been spent on these types of expenses. Then we have this similar report, but this is by division, but expanded, summarized by organization. Again, the same percentage, 43.8% of the total budget spent. Then we have the summary of the fuel and purchase energy by account. It seems similar, the same percentage as previously covered, 34.7%. Then the personnel O&M spending by account. Here we have all the personnel services, including the taxes and the associated fringe benefits, 47.6% of the budget spent. And then, as previously mentioned, sometimes we have departments, they identify amounts that for some reason or other they're not needed this fiscal year. In this case, we have under Department 2220 power production, they identify 148,944, and this is due to budgeted O&M projects that not anticipated to be completed this fiscal year. So more likely they're going to come back next year and requesting funds for. And also under the water plant, they identify 44,360 for a total amount going to the contingency pool of 593,304. Questions?
I don't have any.
Yeah, I just, can you go back to slide 4? I just from a presentation perspective, maybe,
On which?
oh, I have it on, I'm sorry, I have it on my, it's not, is it 90 then? That's fine right there. Okay. I just wanted to make sure, like the headings, just from, I guess, my understanding, so you have fiscal year, year-to-date, but that's, how many months? Is that 6 months?
6 months. Yes.
Yeah, 6 months, right?
Yes.
And then the other one is the annual, right? 12 months.
The left side.
first column?
Yes, that's
The
12, the full year.
Yeah. Is it too much trouble to put what the budget was for 6 months? So you compare your 6 months budget with your actual, and then you can do this slide as well? Or is that,
No, we can. It's just split it in half.
I mean, you can kind of eyeball and say, okay, we should be at 50% of our budget, because half the
Mhm.
year's probably you're at 43.8. Yeah, either, if you don't, not necessary, but at least I would put the time periods at the top. Like this, or you can put fiscal year, because you have fiscal year to date approved budget, you may put annual, and this one just puts 6 months.
Okay.
Is this going to go to the board, Mike?
Yes.
Yeah, so that, for that clarification.
Okay.
Okay. It's just a small little thing. All right. Any questions? Nope. Nope. Thank you very much. Okay, presentation discussion of the fiscal year 2026 budget calendar.
Yeah, so committee members, it's time of the year, once again, where we start with our annual budget process for FY26. The process starts in late May until the budget adoption plan for early September. Each task in the calendar leads to the next event, and for this reason, it's important to stay on schedule. Looking at the calendar, at some of the key dates, May 28, today, we're presenting the calendar to the Finance Committee. Then on June the 2nd, we're scheduled to present the calendar to the full board, and at that time also, on that day, we have the budget kickoff, where we open the budget program for data entry. Continuing with the month of July, on July the 18th, the first draft of the O&M budget is complete. Later in the month, time is spent analyzing the O&M budget in more detail with the goal of balancing the O&M budget as well as the CIP budget. For the month of August, August the 6th, the budget in draft form is presented to the Finance Committee. August 11th, it is presented to the full board. And then the week of the 18th through the 22nd, budget briefings are held with individual board members. Then finally, in the month of September, September the 3rd, the budget draft is presented in a board workshop. And then September the 8th, the balanced budget is presented to the board for approval. Any
Okay.
questions?
No questions. Thank you.
Thank you.
Okay, item number 6, presentation, discussion, and possible recommendation of status of request for proposals for a vehicle lease program.
So, yes, so back in March, we presented this, or discussed with PUB's needs of replacing approximately 27 vehicles through a lease option that encompasses a comprehensive maintenance program and a full management program that would enable BPUB to furnish its departments with the latest vehicle options while ensuring the maintenance of a safe and operational fleet for continued operation. So at the time, we were asked to conduct and provide a cost-benefit analysis between a purchase and a lease vehicle option. It did take a while to gather all the necessary information, but the analysis has been completed, so today I will focus on the analysis. So due to a lapse of time, we did obtain a letter from the vendor where they did agree to continue to honor their bid price. So we're still good there. So we evaluated a 3-year and a 5-year lease term option. The vendor provided all the lease quotes for each of the vehicle and lease terms. The price of the vehicles, we can see here, this is the first one is the 3-year lease. We can see that the price under the lease option and purchase option are different. And the main reason there is because the leasing company usually buys in volume and they buy directly from the manufacturer. So they're avoiding the dealer's markup. And so that's why we see that difference there in the purchase price. Now, the leasing company does recover the vehicle's price through a monthly depreciation reserve. So under the 3 years lease, they recover about 1.5% on a monthly basis. So at the end of the lease term of 3 years, they would have recovered 54% of the vehicle's price. The remaining 46% is their estimated book value at the end of the lease, which is what they expect to sell the vehicles for at the time. So, and we'll discuss in more detail later on that book value at the end of the lease term. So, under this particular lease option, there are some upfront costs under the lease option for administration and delivery fees, and those total $25,393. The annual lease payments, which includes the monthly depreciation reserve and a monthly lease charge, total $333,792. The lease program includes a full maintenance program with an estimate of 10,000 miles, which is 30,000 miles per the lease term. So there won't be an annual true-up. What they do is we will true up, in essence, as soon as our vehicles reach the 30,000 miles. So, for instance, if one of our vehicles at year 2.5 reaches the 30,000 miles, then at that point the leasing company says, so we've already fulfilled our commitment under the maintenance program, and so but they haven't collected the full premium. So at that point they'll bill us for the remaining 6 months to pay immediately, and then any repairs or maintenance for the last 6 months will be on BPUB, right? So now the annual cost for the maintenance program for all the 27 vehicles is at $16,153. So now under the lease agreement, these vehicles are required to have full coverage insurance. So we did contact Texas Municipal League, which is our insurance provider, and they provided an annual quote here of $37,572. There is a service charge of $495 due per vehicle at lease termination, so that they can sell the vehicles, right? So we do have the option to purchase the vehicles at that book value at the end of the lease term. If we do so, then we avoid that $13,365 charge. But if they were to then sell, we would have to pay that $13,000. So the total one-time annual cost under the lease option was $426,275. The total 3-year cost was $1,201,309. Now, when we talk about the estimated book value at the end of the lease, as I mentioned, under the lease, that's $608,238. That's the full book value that they estimate for the 27 vehicles, at 46% that they didn't recover through the monthly lease payment. And so what the company's going to do, they expect to sell the units for that much. If they sell for the $608, there's no benefit or additional cost to PUB. So that's why we don't have any resale value benefit here for PUB under the lease option. Sell for $608, the lease ends, we spend $1.2 million. If they sell for $10,000 above the value, then we would either get a check or a refund for $10,000, or it'll just be applied as a credit to a future lease purchase, and vice versa. If we sell for $10,000 less, they will bill us for the $10,000, but we will then have to pay for that difference. So under the purchase option, of course, our purchase price is $1,383,994. Our insurance costs, we are self-insured, so the only quote that's on here is for liability insurance only at $12,126. And then we've got maintenance costs and repairs at $16,153. So considering the fact that so BPUB under the purchase options would cover all the maintenance costs. And so for this analysis, what we do is we use the same maintenance costs that was quoted under the lease option, considering that that the lease company, when calculating their maintenance costs, already looks at the manufacturer's required services and the probability of warranty repair events based on the average timing of millions of repair orders that they've already completed. So we figured, for comparable purposes, we'll use the same amount. It's at $16,153. So the total one-time and annual cost under the purchase option is $1,412,273, for a grand total of $1,468,831 over the 3-year term. Here again, the cost, the insurance and maintenance costs there are annual, so we did multiply that by 3, but the purchase price is just a one-time cost. So in order to keep the analysis on an apples-to-apples comparison, we are still assuming that the vehicles are sold back at book value, and so thus providing BPB with the benefits which directly offsets its purchase costs, right? So if we do sell for $608,000, that'll reduce the $1.4 million. We do auction the vehicles, and so we do pay the auctioneer's commission at 5%, so we deducted $30,000 off of that. So the net year cost, 3-year cost, under the lease option is $1,201,309, compared to $891,005 under the purchase option, for a difference or additional cost of $310,304 over a 3-year term. Under the 5-year analysis, that cost gap is at $472,000. Now, the decision between leasing and purchasing vehicles should take both quantitative and qualitative factors into account. The lease option is more expensive but offers other qualitative benefits such as shortened vehicle availability. So under the lease option, we should get those vehicles within 90 days. If we were to go out and purchase, those would usually take anywhere from 120 to 180 days. So it's just a few months. Now, under the lease option, it does offer the latest safety technology, especially if we're cycling the vehicles every 3 years under a 3-year lease. We do have some lower upfront cost. Obviously, we don't have to come up with the $1.4 million to purchase all the vehicles, and so we can direct some of that additional funds to other capital needs. There are benefits of an all-inclusive full maintenance program. It will minimize vehicle downtimes and allows for continued operations. We do have shortened vehicle replacement schedule. Like I just mentioned, a 3-year lease would offer maintenance cost savings, considering that most repairs will be covered under warranty rather than keeping vehicles for over 12 years until such time they're inoperable. So that's basically what we're doing. We're currently keeping those vehicles until they can't run anymore. And so those latter years is where we're seeing those increased costs. Especially, we see more extensive repairs for like transmission or engine repairs. And so that's what we're trying to avoid here. So in conclusion, we do intend to present this to the full board on Monday with a recommendation to enter into both a 3-year and a 5-year lease agreement. Out of the 27 vehicles, 11 are just standard vehicles. The other 16 will require aftermarket equipment for utility service body and for some tummy lift gates. And so the thought there is that those 16 vehicles that require aftermarket equipment, we can go extend out 5 years, basically because they're specialized equipment that's being added into the vehicle. And they're not going to be fully depreciated in 3 years, and so we're not going to really be able to recover the book value. And so at that point, we will have to then pay the leasing company the difference between the actual sale and the estimated book value. And so we did not include those scenarios with this presentation, but I did provide a separate handout, which breaks out the 11 units at the 3-year lease, and the 16 units at the 5-year option. So that will be our recommendation, but this committee certainly can provide their own recommendation.
So, thank you very much. I mean, you know, well, we gave away a set of our vehicles to the city last time, and that's something to consider when thinking
Right.
about, you know, covering money at the end of life for these vehicles. You know, the aftermarket equipment, the idea of outfitting it and then kind of losing that value is a sticking point for me.
Right, which is why we would recommend going the 5 years, because at that point, that equipment would mostly be fully depreciated, and we wouldn't lose out between the actual sale and the book value that's remaining on the vehicle.
So, yeah, it would be nice to know roughly how long we get for the lifespan of some of this aftermarket equipment. I mean, you know, it may be depreciated by 5 years, but if it tends to last 20 years, well. it's
Right,
something-
right, but here again, it's very specialized equipment, so you don't have many buyers out there. So that's why I'm saying that we're probably not gonna recover the book value that's remaining at the end of the 5 years, or at the 3 years.
Right, so, I mean, we lose that value is something.
Under a
that-
3-year, yes. If we go 5 years, we lose less, I guess that's what I'm trying to
Yeah,
say. Because
yeah,
they're
but we still lose value.
exactly.
So, I'm sorry, go ahead.
Oh, that's all, yeah.
So, like, Mike, on this one here, then, the 5-year lease, and you know, cars is not my thing, car loans are not my thing, auto leases are not my thing at all, okay? So, just on this slide here, though, you have the lease option, 5 years, you have that cost at $1.8 million, and if you buy it, the cost is 1.5, is that correct? So the difference of 270,000?
That's correct.
But you're recommending the lease?
Right, it's just, again, we're looking at other quantitative
Okay,
benefits.
But the cheaper is the purchase.
Right,
in every
it is.
scenario.
It is cheaper. But then again, we don't have a policy in place or really the funds to replace these units every 3 or 5 years. Like I mentioned, what we've been doing is we've kept those units until they don't run anymore. So a lot of the benefit really that's not shown on here that we would actually see by going through a lease option would be that we don't incur those hefty maintenance and repair costs after the warranty expires or those latter years.
Yeah, but so you're not putting the purchase option, you're not putting, I agree, maintenance and repairs, you're putting a pretty low amount there, but,
Right, because in this case, we're matching what the lease company
I mean, you
is
should have
estimating.
all this data, right? Like, you should be able to say, hey, look, we keep these cars for 10 years, and after year 5, which is when this really matters, this is what we would be spending for maintenance.
Right, and we can generate that information
I think-
for the board meeting.
That'll help, because, you know, right now, we're asking for like $11,000 extra per vehicle just to lease them. You know, and it's like, okay, well, we need a little bit more to justify that if we're going that route.
I think there's questions, and I would maybe add another slide as far as this, you know, those other quantitative factors you're talking about, because here, and just the numbers in black and white, you're showing, you're going with a more expensive option, but that's, may not necessarily be true, right, based on some of the assumptions that you made. And I don't want to get this, I think we need to make a decision here, we don't need to table this, or,
Yeah.
but, okay, so I'm just kind of thinking, okay, 5-year costs $1.8 million, purchase $1.5 million, plus if you sell it for half the amount, instead of saving, you know, instead of selling it for $200,000, you sell it for $100,000, you know, fire sell it, you're gonna save $370,000. And so, if you're gonna go the other way in your recommendation, my thing is, okay, we have to be a little bit more, the justification needs to be a little bit more easier to laid out, I guess, for the whole board, because then I think we're gonna go and
Yeah.
there's gonna be a lot of questions about this, and then we come back and delay or anything.
Okay.
The
We'll
cost
include-
of the money, I mean, you even mention it, but you don't quantify it. Seems like, hey, look, we're spreading this money over 3 years. What's that benefit?
Right, right. And as we saw earlier during the 6 months budget presentation that was presented by Mr. Santillan, we saw that fleet or those transportation costs were actually over the 50% mark. They were at about 67%, and that's where we're seeing those repairs
At 1.2
for our
and 800,000.
current fleet that we're just incurring those higher costs. But we'll try to quantify that for Monday, what it's really costing us on average.
Yeah, and feel free to also mention the fact that, hey, look, we do tend to give vehicles to the city of Brownsville, and that hasn't been factored in here, but is, that was $100-something thousand.
Right, so if that were the case here, so in this particular 5-year lease, we'd be looking at this 270,598 difference, right? If the units would have been transferred to the city, we don't receive that benefit of 212.
Okay. Do you have any questions, Mike, for us, in what we just talked about?
No, I gathered all your inputs, and so
Okay.
we'll include that in the presentation for Monday.
Great, thank you. I
Thank you.
really want to put this behind us.
Yeah, yeah.
Okay. Number 7, presentation, discussion, and possible recommendation for the selection of a firm to conduct external audit services for fiscal year ending 2025 through fiscal year ending 2027. Charlie put fiscal year, okay, so for 3 years?
Yeah, from 2025 to 2027.
Okay.
Hi, good afternoon. Good afternoon. My name is George Angel. I am the Acting Director of Finance, and I'm going to be presenting the External Audit Services presentation. So BPUB just recently completed the 3rd and final year of a 3-year contract with our current external audit service provider. And so we needed to go out for RFPs to get somebody in place to audit our fiscal year 2025, hopefully by July, to give them enough time to have a presentation ready for the board, February of 2026. And so I'll start off with the agenda to give you a brief overview of what I'll be covering today. So first I'll talk about the RFP and the respondents. Then I'll provide some history on past external auditors. I'll talk a little bit about GFOA's recommendation in regards to procuring an external auditor. I'll describe some of the advantages of choosing an external auditor with utility experience and why that's important. I'll go over some general info on all of the respondents, provide some pros and cons for each of them, and then lastly, I'll go over the review team's recommendation based on the review and ranking of each of the proposals that we saw. So jumping on to the request for proposals and respondents, the RFP was advertised on March 22nd and March 29th. It closed on April 23rd of 2025. Purchasing helped with contacting 11 vendors and invite them to provide a proposal. Of that, we received 3 respondents. That's Baker Tilly US LLP, Burton McCumber and Longoria LLP, and Carr Riggs and Ingram LLC. And so within the RFP, we did write a selection criteria. So we had them describe some of these criteria in their proposal so that we could review and rank them as we reviewed them. And so we'll start off with the audit approach and methodology. We wanted them to provide a cost sheet of what this would cost based on the hours estimated on the work. We wanted them to provide references and past performance. We wanted to see if they had an understanding of the audit requirements for BPUB. We wanted them to talk a little bit about their experience and expertise. And then lastly, the available resources and timeliness of meeting those timelines for us in March. And so just to give you a brief history of the external auditors that we've had in the last 10 years, if you can see there, the last 3 auditors that we've had were actually the 3 auditors that responded to this RFP. So we're pretty familiar with all 3 of them: Burton McCumber Longoria, Baker Tilly US, and Carr Riggs and Ingram, and then Long Chilton back in 2015. And then the GFOA does provide some best practices and recommendations when selecting an external auditor. And so I did want to read this because this is a professional organization that BPUB does subscribe to. And so it does say governmental entities should enter into multi-year agreements of at least 5 years in duration when obtaining the services and independent auditors. Such multi-year agreements can take a variety of different forms, for example, a series of single-year contracts consistent with applicable legal requirements. Such agreements allow for greater continuity and help to minimize the potential for disruption in connection with the independent audit. Multi-year agreements can also help to reduce audit costs by allowing auditors to recover certain startup costs over several years rather than over a single year. And that's why BPUB chooses to do a 3-year contract versus a 1-year contract.
Why not a 5-year contract?
That's just been the preference of the board, that they've wanted a 3-year, but we can do a 5-year if the board wishes to do that, or we can even do a 3-year with an option to renew an additional 2-year periods. That's really up to the board, but we don't have anything in place that says that it has to be, that we're stopped at 3 years.
A question on that, it says you should enter a multi-year agreements of at least 5 years, though.
Yeah, so again, these are best practices. Again, we don't have a procedure or policy in place that dictates how many we should. This is just a recommendation from GFOA and best practice that they give to organizations.
Can I recommend that, whoever we select, we consider a 5-year?
We can definitely do that, because that'll give the firm more time to get familiarized with BPUB's financial transactions, and it actually makes it easier on staff to work with them.
Right.
So if we go a 5-year route, that actually works better for us.
Okay.
And then some of the advantages of a public accounting firm with utility accounting knowledge. I know this is kind of a busy slide, so I won't go through all of them, but I did want to highlight 4 of these in particular that we thought were important to mention. And so we'll start with the second bullet point. So the ability to review and audit BPUB's complex transactions as an audit team, at the audit team level with minimal consultations required. And so when we were going through the proposals, most of the firms assigned a specific team within their organization to BPUB. And so they did provide their resumes, and so that's one of the things that the selection committee was looking at exclusively to see, do they have past experiences with utility, and then specific with either electric, water, or sewer, because some utilities offer either or. We offer all 3, so we wanted to make sure that we had somebody who had an extensive background on all 3 of the utilities that we provide. Then we go on to the 6th bullet point: no need for management team to train firm staff on the utility industries of your operations. So again, we were looking for a firm that we could learn from, and not the other way around. We didn't want someone who's going to be asking us questions on what is it that you're doing. We want somebody that was going to come in with prior knowledge and say, this is what we can offer based on what we know of BPUB. And then right underneath that, assist management with implementation of GASB standards and provide example note disclosures used by other utility clients. GASB standards, we usually have GASB standards that are amended year over year, and they're usually pretty vague with the implementation of that. And so it's really up to the organization to determine whether that particular amendment applies to your organization or not. And so having an experienced firm with GASB standards and those amendments who can also provide disclosures that are applicable to those amendments, giving us examples to those, that really helps us to be able to have that put in place as opposed to coming up with something from scratch.
Government Accounting Standards Board.
Correct.
Okay, just a guess, wanted to see.
Yes, correct. And then lastly, provide examples and white papers on how your peers account for similar complex transactions. And so again, just going back to the resources, we really wanted somebody who was going to have really heavy utility experience to be able to share some of those implementations that are already done with some of their other clients. And then so these were the responding firms, and there is a little bit of general information. Again, this is kind of a busy slide, but I really want to hone in on the number of utility industry customers that each one of them presented. And so if you look here, Baker Tilly by far, 1,600 utility customers that they currently have in place, compared to 1 at Burton McCumber, which is PPUB actually, and then Carr, Riggs, and Ingram reported 7. And I do want to say that the 7 that they reported are water organizations, so water utilities, not really anything with electricity. And then in terms of the last 4 that we see on here, the timeline, they all are able to meet our timelines that we have. July through January is what Baker Tilly is listing down. Burton McCumber and Carr, Riggs, and Ingram both had July to February, so that is well within our timeline that we have in March. And then you can see the number of estimated hours down below that they're planning on having staff reach out to BPUB when they're conducting the audit. The final 2 rows that you see down there is the price. And so if you see there on the far right, Carr, Riggs, and Ingram's, it's the cheapest option, $67,500. Burton McCumber is there at the midpoint at $75,500, and then you have Baker Tilly at $85,000 at the highest. And so that's really one of the factors that we had as well in the selection criteria. And so just a little bit of pros and cons for each of the firms. If you see on there at Baker Tilly, again, over 1,600 utility clients, which is really important to us. Unlimited resources in the sense that they have those 1,600 utility clients that they can reference to us whenever we need help with disclosures, GASB amendment understanding. They're familiar with BPUB because they have been our past auditor, and they have been our past auditor. The only con for them is that they do have a higher net price. For Burton McCumber and Longoria, they are our current external audit service provider, and so they're very familiar with BPUB. They are the mid-price point for all of the respondents that we had. Cons on them is that they do have limited resources, and unfortunately, we are their only experience with utility clients. And then Carr, Riggs, and Ingram, again, because they have familiarity with the BPUB, they were our auditor in the past. Their biggest pro is that they have the lowest price point. And then their biggest con is that they did not provide any utility references that were relevant to BPUB. And
I've
so
seen the quality of their audits.
Yeah.
Not really interested.
Okay. And so lastly, the team recommendation. So it is the recommendation of the RFP review team to award Baker Tilly US LLP a contract to provide external audit services for BPUB. So at this point, I know that the initial request was for a 3-year, but we can always amend that as a 5-year. And again, this is just a recommendation based on the proposals and the way they were ranked by the team. But of course, the committee can make a separate recommendation if you all choose to.
Yeah, can you go back?
Sure. To a slide in particular, or?
No, the one before. Yeah, I mean, my preference is to go with if the work that if the work that the auditor does is quality work, right, at the end of the day, I mean, they report to the board, right? The report is for the board. And so if it's quality work, well-established firms have proven in the past that they can, they can do it.
Yeah.
And then you've got 2 local firms that are cheaper than the Austin firm.
Yes.
I don't necessarily agree with that. That's just my individual opinion, right? I'd rather go with Burton McCumber or Carr, Riggs, and Ingram. The price points are very, very similar.
Mhm.
Their completion dates in February. I've got confidence that they can meet those completion dates. I mean, Burton McCumber met the completion dates.
Yes, he did.
I didn't, that's my only thoughts.
Sure.
But I don't know what your thoughts are.
Okay, so before I make a comment, I am going to say, for full disclosure, my dad used to be a partner at I think it was BMP at the time, I don't know, but at Burton McCumber, fill in the blank for the last final name, and it changed. He hasn't done work for them for years, so I just want to make sure that that's known, though there is no conflict of interest. Now, the thing I would like to ask staff is, did you notice any of these limitations while working with BML, Burton McCumber, Longoria?
So for me in particular, right, because I was here part of the audit in 2025 and 24, 23, and 22. And so I think for me personally, the only thing that we had is that there was a lot of us asking questions to Burton McCumber, specifically on GASBs that had come out. We had a GASB 87 come out on capital leases, and it was more of a, well, I'm not too sure. Let me see if I can research and find out. Right, so it was more of a, I expected from a prior, for example, Baker Tilly, who was the auditor before, I expected a, yes, we are familiar, these are the disclosures that you all should have, this is a test that you all can run, whether this should be implemented in your organization or not. Right, so there was a lot more of us having to ask questions to Burton McCumber and staff to try to get information. Not that they wouldn't get the information, it was delayed because they had to do research to figure out what we were asking, as opposed to Baker Tilly, where we would ask and they already knew the answer.
Okay, were these delays significant?
The what?
Were these delays significant?
No, I wouldn't say it was I wouldn't say it was significant because they were able to meet the timelines. The only thing is that we were delayed in finding and including disclosures in our ACFR to be able to. It was more us having to come up with information and then asking them, does this sound right? As opposed to, give me an example of how I should write this. Yeah. So I don't want to say that it was a delay. It was just more. It just took some time.
Okay, I tend to agree with the supermodel to my left. I'd rather go with local on this.
Sure.
Okay.
I had a similar experience here. I know that because we implemented the gas hedging program, that required a lot of different disclosure requirements and accounting requirements, and they had no experience regarding that. So we actually had to get the guidance from Experience on Demand
Yeah.
or other consultant to guide us through those note disclosures. So similar. Again, it's just they didn't have quite that experience, but they did a good job, though.
Yeah. I don't see that as being a big, a big deal, to be honest with you. You know, I'd rather, I think they're both, these firms have been around for a long time. You know, they're different, right? But they have local offices here, and they can get the work done, and they can give us the opinion and do that. I think sometimes it depends on the auditor that you get, right? You know, I mean, so you know, I think that it'll go before the full board. I'm just like we did with anything else, if there's an opportunity to do business with a local firm or whatever, I'm gonna do that 100% of the time, as long as they're qualified and it doesn't cost a ratepayer, you know, extra money.
Sure.
Right? And so I think these two are, I saw the quality of the work that they did, the communication, you know, so I would say it's either or, but we can have that discussion at the board, just to.
Okay, so what we can do is we can change the recommendation
Yeah.
for the board meeting, you know, just noting that the finance committee will make a recommendation to the full board. And so we'll leave it up to you all.
During that meeting.
Right.
Yes.
You can make your recommendation and the board can discuss and approve.
And then vote.
So we'll do that instead of us making the recommendation.
Okay.
Yeah.
Okay.
Sounds good.
Okay, thank you.
Thank you. Thank you for the presentation.
You're welcome.
Great job.
I think that was the last item on our regular agenda. There's no items for executive. So with that, Mike, do you have anything else?
No, nothing else?
No? I'll entertain a motion to adjourn.
I'll move to adjourn.
I'll second that. All those in favor? Aye. Thank you.
Oh, he's low.